Social and economic concerns are growing, and climate change is speeding up. Like a train that, once rolling, keeps racing towards the abyss. We push it further, throwing coal into its boilers, through our consumption and our way of doing business. With their CO₂ emissions, corporate activities cause environmental damage that costs society a substantial amount. On average, these costs are almost as high as half of the corporate profits. The long-term consequences? Natural disasters, refugee streams, and conflicts. All of this also has an impact on companies, threatens their existence, and could shake up the global economy and change life as we know it forever. About time we pull the emergency brake. But how? With bans, taxes, subsidies? Or can transparency help us set the right course? Will companies become more sustainable if they have to reveal how much CO₂ they emit and how socially responsible they are? Or when they have to explain how droughts and other climate consequences affect their economic situation? In short, will sustainability reporting help us? Sustainability reporting is intended to increase the pressure on companies. After all, companies that cut a poor ecological and social figure must fear being less attractive and falling behind their competitors. This should encourage them to make their processes more sustainable. In recent years, more and more companies have started to report voluntarily about their steps towards more ecological and social sustainability. In this way, they want to stay ahead of investors and customers and become more attractive to employees. Sustainability is becoming increasingly important for these stakeholders. However, the risk of greenwashing and bluewashing increases precisely where external pressure is greater. There is a risk that companies will present themselves in a particularly positive light, although in reality they are not as ecologically and socially sustainable as they claim. In order for companies to present a fair picture, they need firm guidance and regulations. For this reason, reporting obligations have been introduced in recent years. They specify how companies must report, and about what. One study shows what reporting obligations could achieve. Within each industry, there are companies that emit more CO₂ per dollar of profit than half of their competitors. If reporting obligations could coerce these companies into reducing their emissions to their sector median level, this could reduce CO₂ emissions by 49% overall. A huge effect. But can the current reporting obligations achieve this? A study by the German Business Panel shows reporting obligations do not automatically cause companies to change their behavior. More than 3/4 of the companies surveyed that have to report in accordance with the newly introduced European Sustainability Reporting Standards do not intend to change their business policy. For many companies, market pressure has therefore still no effect, especially for smaller companies, and for those who do not yet use sustainability indicators internally to better position their own company. But why is that? Many companies currently only seem to see the bureaucratic monster that provides competitors with sensitive company information, that causes costs in data procurement or in the training of employees. However, they often do not seem to notice the opportunities offered by the transition towards sustainable processes and business models, or the losses that companies would face if stakeholders work to punish them for their environmental and social performance lagging behind that of their competitors. Many consider the new regulatory requirements to be too complex and bureaucratic. They want to focus on a small number of established key performance indicators. Many find it difficult to keep track of the seemingly constant flood of new regulations. This is where research is needed. TRR 266, Accounting for Transparency, is working on approaches to streamlining reporting obligations and help companies stay on top of requirements. One of these approaches is the Sustainability Reporting Navigator. This publicly available platform compares the different requirements and breaks down for companies how and what they have to report on, and which information is particularly important for their stakeholders. However, despite binding reporting obligations, greenwashing and bluewashing are not yet off the table. There are still loopholes that companies can exploit, and which they will use if the costs of reporting truthfully are greater than the benefits. Among other things, this concerns the disclosure of greenhouse gas emissions that occur outside the company but within its value chain. The GHG protocol, for example, does not require companies to distinguish between actual and estimated and between past and future emissions. This helps companies to disguise whether they are actually reducing their emissions. However, approaches have already been developed that could complement the current reporting obligations. For example, a reporting structure that addresses the weaknesses of the GHG protocol and helps companies to report in a more reliable way. Other researchers, on the other hand, are discussing stronger enforcement of existing rules. This results in additional costs for companies that do not comply with the rules, and this could discipline them. And there are those who believe it is important to encourage companies to include the effects of climate change and their societal impacts in their core financial statements. If, for example, a ban on combustion engines is introduced, car manufacturers would have to quantify in their annual reports what this ban would mean for them financially, for the value of their production facilities, for example. The information in the annual financial statements is prepared under strict internal controls and audited by independent auditors. They would therefore serve an important control function for sustainability reports. So, a lot still needs to happen for sustainability reporting to help bring the train to a complete stop. Reporting must be simplified. Reporting gaps must be closed. Assistance and incentives for companies must be created. Business research on corporate and regulatory transparency helps to identify suitable measures and the right balance between the benefits and the costs of sustainability reporting for the good of the environment and society.